Yes, I think the psychology is what's been pushing things around. And as you know, Kelly, we've continued to be positive and do think that things are moderating, but this isn't collapse, this isn't recession. And our message has been, be careful what you wish for, because my experience is that hot, steamy, robust is just as bad for the financial markets as is recession. And what we see is a steady as she goes kind of pace, not a perfect steady as she goes combo, but pretty nice combination of positive but moderating earnings growth, low inflation, low rates, and that's a good cocktail for equities from our viewpoint.
I guess my question is, when you say this to clients and explain the landscape as you see it, do you get this pushback? I mean, are people out there themselves feeling like they need to hunker down? They say, look, I see these headlines about the yield curve. I feel like the cycle's gone on too long. I want to get more defensive. I mean, or are they receptive to what you're saying? And is there some optimism still about this cycle?
Yeah, by and large, they're receptive, and certainly we have had dialogue with them about the things that we look for recessionary signals, so they've become comfortable with that. Now, you always get a small subsegment that really do get concerned, and then you need to talk about, potential adjustments that they should make just to sleep well at night. But by and large, people are pretty much comfortable that the data is solid, and that the risks are that you get whiplash, you move away from equities at the wrong time, and then you miss the rally recoveries. And
Lindsey, there's some specific parts of the data that are setting off alarm bells. Namely, you can look at freight volumes. The Cass freight indexes are out there saying a slowdown is here. It's happening. The manufacturing numbers haven't been that strong. Even some of the wonkier stuff, like you had J.P. Morgan last week saying, quote, the noose is tightening around corporate profits because of what's happening with labor costs and productivity. Is there a worrisome trend here for profits and for business investment we need to keep our eye on?
Well, I do think when you look out to 2020, you see 11% earnings growth, and that's pretty robust considering we still have this tariff issue as a cloud over the economy and the markets, okay? So I think that those numbers do need to come down as we move forward over the next few quarters. But yes, of course, there are pockets of weakness in the domestic economy, but I'm more worried about the global economy. The PMIs that we're going to get tomorrow, have they been able to stabilize, or are they going to continue to contract?
Right.
So that's really going to be the most important thing to watch, especially for the Fed.
For the markets in general, it's a bigger problem than it is for the U.S. economy. I mean, what's the S&P exposure to earnings overseas? Probably something like 25-30%, whereas the U.S. economy is more like 13%. So even when corporate America sees that slowing, is it something that, quote unquote, the rest of us need to worry about?
And that's the thing. I think that the media might be making a bigger deal of it than it really needs to be, because we are not an island in the U.S., but it does take some time for the slowdown that you're seeing around the rest of the world to get here, because we are not this big manufacturing economy that we once used to be. That's more in Europe and in Asia, and that's why you're seeing the weakness over there more so than you're seeing it here. And the consumer remains very strong. Look at the fundamental data. We're seeing this uptick in the market today on fundamentals, out of Target, out of Lowe's. New home sales were better than expected. Even last week, retail sales very strong, small business optimism. The last 2 weeks, I've been encouraged by the fundamental data.